All right, everybody. Appreciate those that are starting to trickle in here. Simon, I want to make sure you can hear me okay. Bottom left there, Simon. I don't know if you're there.
I can hear you well. Can you hear me?
Perfect. All right. As always, thank you to those that keep on joining these daily Spaces efforts. It's going to be a busy one for me. I've got like 6 set up, trying to get the podcast schedule underway, given a lot of travel that I myself am doing. If any of you want to come up and ask questions, don't hesitate. Click on that bottom left mic request button. Happy to bring you up. If I bring you up, make sure you follow me, check your DMs. We'll coordinate when the time is right. Please, folks, let's get some momentum on this space. Share this to your friends, to your colleagues. Click that top arrow at the top of the Twitter space, and let's try to get some good momentum here. And as always, this will be an edited podcast on all your favorite platforms under Lead Lag Live. Over 500,000 downloads over the last 12 months, now averaging around 60, 70,000 downloads per month. So please, folks, keep that momentum there as well. With all that said, my name is Michael Guyette, publisher of the Lead Lag Report, as well as portfolio manager of the ATAC Fund family, ATAX, Roro, and JoJo at Tidal Financial Group. Joining me for the hour is Simon Dixon, who's got a very dramatic Who is Simon Dixon YouTube video I just watched, which, by the way, was very well done, Simon. But for those who are not familiar with you, introduce yourself. What's your background? How'd you get involved, interested in financial markets and Bitcoin in particular? And what are you doing currently?
Yeah, sure. So I'm just a finance money geek. So my first, I was working in investment banking. Decided to leave in 2006 to work on banking and monetary reform. Went down that rabbit hole before Bitcoin was actually created. And we tried to create a full reserve bank, which we failed at epically. We were tried to do it in the UK at the time, told by the Bank of England that you needed 60 million on reserves. You couldn't do full reserve. You had to put all the money with another bank and build on top of their systems. And it was just not possible to do what we wanted to do. At that stage, we sunk all our money into trying to build this bank, and went deep in debt, actually. And took my last bit of credit card debt and went to the first Bitcoin conference in the world, which was in Prague. And I spoke there, and it turned out that they were building a solution that allowed for what we considered full reserve banking. So I wrote a book, which was the first published book in the world to include Bitcoin: Bank to the Future, Protect Your Future Before Governments Go Bust. And then we just started investing in the industry. Bought my first Bitcoin at $3. And when that wasn't in a position where I needed to sell, and so then we started investing in startups that couldn't secure any funding: Coinbase, Kraken, Bitstamp, Bitfinex, and pivoted the bank to actually be a funding platform for Bitcoin businesses. And so when none of these companies could get funding, we started working on securities law reform, and 3 years later managed to get a securities license. And have just been investing in the sector ever since and supporting the industry, and just seeing it grow through every single Bitcoin cycle. The thing that never should have succeeded did succeed, and just been having a blast ever since.
Take us through some of the initial reactions when you would talk about Bitcoin back then. You mentioned buying it at $3, going to the first conference ever on that. I got to assume that conference did not have that many people there, but presumably your friends and colleagues, as you talked about it, were maybe a bit skeptical.
Yeah, well, my thing was I was talking about banking before Bitcoin, and Bitcoin actually was a way of explaining banking better for me. So if you go back to my early YouTube videos, and I've been publishing the whole journey ever since those early days. I've still got the recording of those conferences on my YouTube channel, Simon Dixon. But I was explaining there's 3 fundamental flaws in banking, which I covered in my book, which is that banks own your own money. They own your money. So when you deposit your money at a bank, they legally become the owner of your money. Secondly, they spend your money by allocating all the digital currency that they create where they're going to lend it. So if it's based upon real estate or it's based upon some other asset class, they get to dictate the flow of money because they create digital currency every time they issue a loan. And finally, that determines the money supply. So you end up in this crazy system where central banks are trying to manipulate or figure out what is the optimum interest rate in order to determine how much digital currency a bank creates every time they issue a loan. And so systemically, it's a Ponzi scheme. And I was looking for a way of describing that. And when I was used to give talks before Bitcoin, no one believed me when I said banks created money. They just thought you were an idiot or a conspiracy theorist or a whack job. And so when Bitcoin came along, it gave me a way of explaining the difference between Bitcoin and banking, because I was able to explain to people, hey, Bitcoin is this thing that you actually own. You don't need a counterparty. You don't need a bank in the middle. And because of that, you can spend it peer-to-peer, person to person. It goes from one device to the other device, and there's a ledger recorded on the blockchain. And guess what? The money supply is completely fixed and can't change. And those that validate all the transactions are the ones that receive the seigniorage income, which normally goes to either governments or banks, depending on whether it's digital or not. So Bitcoin gave me a way of describing banking. And the only reason I believed in it is because I realized when I was trying to create a bank, you couldn't do what Bitcoin did. And so that kind of took me seeing it from a different perspective. But yeah, I mean, back in the early days, I used to just sit there, I'd give Bitcoin to anyone that would download a wallet. If you came to one of my early talks, I've given away more Bitcoin than I can count. And the best way to help people understand it was just get them to download a wallet, give them some Bitcoin. And I'm sure a ton of those Bitcoins all got lost because no one valued it at the time. No one cared about it. But, those were my favorite days because it was an aligned vision of there was only Bitcoin. There wasn't anything else. And we were all just there trying to take on the banks and build a system that would work and allow people to transact peer to peer. And it was just, it was a blast.
How much do you think of the Ponzi narrative, which obviously I agree with, is really just there because of the great financial crisis? Obviously, Bitcoin was born out of it, but when you had a government surplus, I don't know if the rhetoric or the narrative that it's a Ponzi system, that everything's fragile, was there because you had a buffer.
Yeah, so in the early days before the financial crisis, so I left my job in investment banking in 2006 to give lectures on monetary reform, and the community was just really geek, really small. We had Kucinich agreed to introduce a bill in order to make fractional reserve banking illegal. We put together a transition plan that involved in what was the equivalent of central bank digital currencies, which you have today. And the Ponzi, like one of my first interviews was with the guy that did that Money Masters documentary, Bill Still. So he interviewed me really early on before Bitcoin. And I do believe that the financial crisis was the catalyst for people caring, because when I was giving presentations at the time, I went from like 30 people in a room. The first Bitcoin conference was about 50 people in a room. And then as the financial crisis progressed, the talks went up to like 300, 400, and just more and more people. And then I did a documentary called 97% Owned, which is on Netflix. And that was really the pivotal moment. We were describing it, and that got about 4 million views on YouTube. And then we realized that this is a narrative that people are interested in. And the great thing about Bitcoin is every time a new event happened, whether it was, the censorship during Wikipedia financial blockade, or whether it was, demonetization in India, where people had to queue outside banks and turn their cash into digital currency because they were trying to actually get some of the tax on it. All of these events, they just led to new reasons for people to understand the rhetoric, until you reach the point today where you have the 2023 US bank run crisis, where the level of financial education because of Twitter Spaces and the speed at which things are happening is, I don't think we've ever had a more financially educated. People just didn't debate these things. They weren't subjects that people cared about, and I experienced that firsthand.
So okay, there's a couple of directions I want to go with that because I think it's an interesting point. So yes, obviously people are much more financially educated, which you can argue maybe makes the market more efficient. We can debate that. But I am curious, given that you mentioned that the GOC was the catalyst, which again we all know that was the case. Has it been surprising to you in at least the short term that Bitcoin hasn't done better in the context of the regional bank dynamic? You obviously saw it, a move initially in mid March. I was on a podcast myself saying this is like, the Bitcoin maxi's wet dream. All right, you have a bank run, you got a crisis in the banking system in the U.S. You had to move and then kind of petered out. Now I know all this is very short term, right? But let's face it, a lot of people do live in the short term when it comes to the FinTwit side of things. I'm just curious to hear your thoughts on why or why not has Bitcoin kind of not persisted its momentum? Is it really a bank crisis? If it's not, maybe that might explain it. But if it is, I would think Bitcoin should really surge, and it just seems to be pausing a bit.
Yeah. So firstly, I disagree. So I don't do short term at all. I've never traded. I had a real simple strategy, which was own more Bitcoin each month than the previous month. So the further the price goes down, the better. I prefer that. I really prefer extended bear markets. They're my favorite times in Bitcoin. You get to accumulate more. People are building more, and you don't have the people that are just here for the dollars. And you have the people that are here for the Bitcoin. So those are always my favorite times to context. But I think the 4-year cycle in Bitcoin has performed immaculately, and I do believe it will continue to perform. Not financial advice, but
And and,
when I
and Simon,
first
sorry,
got,
just maybe for those that are not familiar, just explain what the 4-year cycle is.
yeah, absolutely. So the monetary policy of Bitcoin is that those that run this process called mining, they validate all transactions. I don't want to go geeky into it. Some will have gone down a rabbit hole, others won't. But in a nutshell, you fire up originally a laptop, then it was more sophisticated equipment, and now it's institutional grade mining farms, where they essentially validate all transactions, and a copy of every single transaction is stored on tens of thousands of nodes, so that there's only one version of the truth. So you don't need a bank or central bank. And the monetary policy stated that every 10 minutes, miners one miner would randomly be selected to receive 50 bitcoins. And then every 4 years, the number of bitcoins someone would receive every 10 minutes cuts in half. So we started in 2009. And then in 2013, we had the first halving. And it creates this 4-year cycle whereby the supply is expanding at a smaller and smaller rate until it hits this finite supply of 21 million. And what we started to notice is that Bitcoin goes through a 4-year cycle. And it's so far it's persisted and prevailed ever since I've been involved. So the first cycle is what I call the centralization cycle. So originally, when Bitcoin was created, it was just Satoshi Nakamoto mining and sending some Bitcoins to Hal Finney. And there was a bunch of geeks that were sending some Bitcoins to each other. And it was deeply, deeply centralized. Satoshi Nakamoto, he, she, they, whatever group, actually mines 1 million Bitcoins. And the process of trying to get it to not be centralized and decentralized really dominated the first cycle. And when it showed that you could actually have financial transactions in a decentralized way, it kind of passed its first test. Its second test, which was the second cycle, so that took it actually approximately, God, I think it was like 123,000% returns if you went through that cycle. And then each 4-year cycle, you get multiple 1,000% returns, but it goes down slightly each time as we hit higher and higher market cap. So we're still in the early adoption. So the second cycle is what I call where we had to survive legal crackdown. So, there was a massive hack where 70% of all people that were trading Bitcoin had their Bitcoins on an exchange called Mt. Gox. When that got hacked, the Japanese regulators went berserk. US FINRA said that everybody's got to register these exchanges as money transmitters, and all the different regulators kind of had that choice of outlawing Bitcoin or allowing it to persist, and somehow it survived. And so that went through the second cycle. I think that produced approximately 21,000% returns for people that survived, that went through that cycle. The third cycle was what I call the token printing cycle. This is when everyone started to try and copy Bitcoin and say, hey, I can create a better version of Bitcoin, faster, cheaper, better, more secure. I can create my own blockchains. I can even launch tokens. And we had like 10,000 versions of Bitcoin and tokens, and everyone creating pump and dump schemes. And there was one dangerous one, which is where very prominent members of the community and companies tried to take over Bitcoin and say, hey, we're going to fork it, create a new version of it. And the old one's not Bitcoin. This one is Bitcoin. And that was a real survival thing we had to survive, because if you could create a new version of Bitcoin and now there's 42 million Bitcoins, then it would really damage the fundamental reason why people were considering it digital hard sale money. But it survived that. It turns out that it was virtually impossible to replicate Bitcoin because the way it was created, where no one cared, gave it properties that no one's be able to repeat. So regulators then said these things are securities; they're not commodities. And then you had all these people just keep continually trying to dilute the brand of Bitcoin and create all these alternatives, but it never succeeded. And there's only still one that is actually considered decentralized and commodity like. Then you had the fourth cycle, which is throughout the whole history of Bitcoin. It was always created after the financial crisis in a quantitative easing cycle. So my big test for Bitcoin was, could it survive inflation and quantitative tightening and rate hikes? Because it's never been around in that environment. It went straight into QE, and so people started to trade it as a risk-on asset. And therefore, if you end up in a stock market crash, do you also get a crash of Bitcoin? And it turns out that you do in the short term. But in the long term, the fundamentals of own your own money, spend your own money, and have a monetary supply that can be fixed prevails in the 4-year cycle. And so we're about to end that fourth cycle. And I talk about two more big tests till we can actually classify Bitcoin. And the returns will diminish each cycle. So the earlier you believed, the higher the returns were. So the last one produced a 2,100% return, I believe. Don't quote me on the numbers. I have to go back and remember, because I did all the calculations one time. But the next cycle is about surviving central bank digital currencies, which I believe is an attack on the banking system, not on Bitcoin. And then you have AI, which will probably power those central bank digital currencies in the future. And Bitcoin and blockchain will probably become a force for being able to combat the centralizing power of artificial intelligence when it comes to these things. So these are all the tests. And the 4-year cycle is essentially you hit new all-time highs, and so far had over 1,000% returns for holding throughout that in dollar terms.
Expand on just the idea of a leverage cycle. So I'll preface this by saying I've used this line many times before, that whether it comes to Bitcoin, cryptocurrencies, stocks, commodities, everything has a certain commonality in overconfidence, right? At least in the near term. And I've used that line many times on Twitter. Overconfidence leads to leverage. Leverage leads to crashes. Now, you can leverage up, Bitcoin and cryptocurrencies, a significant amount, and that does at the margin obviously push the marginal price to new highs for a moment in time. But how do you think about leverage when it comes to Bitcoin and its own cycles? It seems to me that unless you have limitations to how much levered fiat you can put into the space, it's hard to get volatility to really drop in a meaningful way, causing a lot of noise and a lot of angst.
Yeah, so let's look at the last two cycles. So in cycle 3, we had the money printing cycle. What we learned was that most people, or a percentage of those that invested in pump and dump scams, and we had, for example, Telegram was launching their own token. The SEC decided to shut it down, but they brought in approximately over $1 billion. And I think the most crazy ICO of all time was someone printed their own token, EOS, and they brought in about $4 billion. Now, with all of those scams and all of those money printing and basically digital securities without the regulations and without the disclosures, people tended to stay. And so what we found is that because we have Bitcoin and stable coins, people wanted to, once they'd onboarded into Bitcoin or crypto or a stable coin, they didn't want to go backwards unless they absolutely had to. And so that was what we discovered in cycle 3, that the market cap and the amount of liquidity in the space increases. And at the end of every scam cycle, everyone returns to Bitcoin, or they exit because they were just looking for a quick buck and some more dollars. But you always end up with a higher number of people that discover Bitcoin is what this industry is about and what the world needs. Now, this cycle, the fourth cycle, was where we introduced leverage. So you had a bunch of scammers that created tokens in 2017. And what they did is they introduced a lot of leverage into the system. Now, it started as what I thought was a very good idea. And it was a simple idea. You got a bunch of Bitcoin. You very rarely want to sell it. I certainly, every time I earn fiat currency, I every single month convert a percentage of it into Bitcoin. And then I also have hedges because, as you get older, you don't want to be fully exposed to one eventuality in the world. So I have hedges in case I'm wrong, but I put most of my conviction into Bitcoin. But what they did is they created services whereby rather than selling your Bitcoin, you could borrow against your Bitcoin. And there would be other people like Bitfinex, one of the exchanges that we invested in 2016. They created a service where those that wanted to, do margin, go short on Bitcoin or do margin trading, you could actually lend them your Bitcoin and share the interest. So they created this order book, and then other companies wanted to, build better user experiences on top of that. So they started to put together the people that wanted to borrow with the people that wanted to lend and receive yield. The problem is that we recreated banking, but without any of the checks and controls, without any of the FDIC insurance, and they started to operate as hedge funds as well. So one thing led to another. It was a simple peer-to-peer lending model, and then suddenly we introduced this massive leverage, and then to the point where a couple of hedge funds, like 3 Arrows Capital, that just scammed everyone and then decided to launch their own exchange where you could buy and sell bankruptcy claims, is what they're doing now. And another one, which was Sam Bankman-Fried with FTX, decided that they would, create a hedge fund, Alameda, and they would go around all these different platforms and borrow from them. So when you thought, and then all those platforms, they were all competing to each other to offer the best yield. And that led them to offering unsustainable yield, taking higher and risks. And essentially, we created a worse version of the 2008 financial crisis, which was just an awful moment for our industry. And I even got roped in. I had, approximately 1,000 Bitcoins on one of those platforms. I was actually implementing a hedging strategy where I was going to borrow against my Bitcoin and buy gold as a strategy, and I wanted the yield to pay for the interest. That blew up. I ended up a creditor in one of those platforms, Celsius. And when all the leverage blew up, it turned out that it was absolute scams, fraud. People were using, rather than, because there was no bank oversight, there was no, Basel requirements. They were just simply using all your money for all sorts of craziness. There was multi-billion-dollar holes, and they were all overexposed to each other. And then they were lending to each other without being over-collateralized, which broke the whole model. And we had the 2022, crypto deleveraging cycle, that brings us back to where we are, where a lot of the leverage is taken out. That brings us to, and then obviously that had its impact on the 2023 treasuries and how that impacted the banking sector.
Do you get a sense that the drawdown this time around was maybe more damaging from a institutional adoption perspective than people realize? I mean, I've there was a lot of movement in the institutional space around Bitcoin as things were surging out of COVID. I get the sense that there might be sort of a almost like a behavioral finance snake bite effect, once bitten, twice shy type of dynamic where because the institution started getting more and more involved and engaged, just as things were about to go through a drawdown, it might take some time and maybe longer than people realize to get the adoption, which I would think a lot of the real maxis want to see.
Well, I saw a couple of things. Firstly, I saw all the crypto people wanting to convert to Bitcoin. I saw all the people that put their money in centralized platforms figure out how to create, get a hardware wallet and figure out how to do self custody. Every cycle that I've seen, there's always a disaster. So, like Mount Gox was when, for example, when Mount Gox went, well, the first one, when Mount Gox went bust, it was over. It really felt like everything was over. And when the Silk Road got shut down, that really felt like it was over. When Eric Voorhees got, contacted by the SEC for doing a Bitcoin IPO and creating, a gaming site, these all felt like moments where everything was over. But in this cycle, every single cycle, we've had, you have more individual adoption. So prior to this, it was definitely retail adoption. But in the last cycle, you had like the Michael Saylors of the world that were doing conferences, bringing in all the corporates, and people started using it for corporate treasury management. And you also had, we tried in 2014 to make Isle of Man use Bitcoin as legal tender, but they got threatened by the Bank of England. And so therefore had to stop it. But El Salvador actually stood up to the Bank of England and the IMF and actually implemented it as Bitcoin legal tender. So you had sovereign management, and then you had the higher risk financial institutions that were finding, that were getting into all of this. But they were all jumping into, a lot of them were jumping into crypto. Some of them were going straight into Bitcoin. So it's a real mixed bag. Obviously, you had Facebook trying to create their the largest bank in the world with the Libra project that was later bought by Silvergate. You had banks that were actually, we had sustainable banks that were, providing banking services to exchanges. And so all of this infrastructure created, larger and larger institutional adoption, sovereign adoption. And so when those all get burnt, they go through the same cycle as everyone else. Some of them find Bitcoin, realize that all the rest is a bunch of shit and leverage. Some of them exit the industry and they come back once Bitcoin hits record highs. Every time Bitcoin reaches record highs, I get people that are contacting me. I get institutions. I went around every single fund manager in approximately 2015. I was paid by Jefferies Investment Bank to speak to pretty much every fund manager that were managing most of the world and most of the world's, a decent chunk of the world's money. And I explained to them Bitcoin, and it was actually Blythe Masters who was explaining why you shouldn't buy Bitcoin and you should be investing in blockchain. And she was doing the round, and we were doing the same round. I was saying Bitcoin, she was saying blockchain. You get people that adopt, you get people that get burnt and disappear, and you get people that stay there and realize that actually Bitcoin is a thing. The difference this time around is you're going to have all those legacy financial institutions that are saying, right, it's time for the grown-ups to step in. We'll do this where centralized companies are done in a regulated way. But you still got, BlackRock still has their fund that has to allocate a percentage of it to every public company involved in Bitcoin and blockchain. We had Coinbase that did the first IPO. We were early investors in some of their private equity rounds. Some of our other portfolio companies like Kraken, Circle, Ripple Labs, they were all exploring their IPOs. And so, yeah, that's I just believe every time I see it that you've got higher levels of adoption and a bunch of people that got burned, and how they react to that. Do they react to that to realizing that Bitcoin is where it's at, or do they leave? And you get a little mix of the, but they tend to come back later.
Yeah, and to your point, I think there's certainly a lot more attention to it than before. So full disclosure, at the RA that I'm a part of, Title Financial Group, we're the ones behind the blockchain ETF, BLOK. That's our fund, and the AUM went
Oh, I didn't
wild
know
on.
that. Thanks for
Yeah, yeah,
explaining
yeah.
that.
It's actually Mike Venuto's in the audience. He's the co-founder and CIO. So I work with him closely. But it's funny because I often rant against narratives, and people think I'm anti-Bitcoin, not realizing that I actually want to see the space do well, but for the right reasons. The right reasons being not overconfidence, greed, leverage, but sort of the core purpose of what Bitcoin is ultimately about. But the my point in referencing that is, the performance went through the moon, through the roof, and then came back down. But there's still a lot of sticky money that's there. So you've had the sort of weak hand momentum chasers, and then those that really understand and believe in the space. That's a plus, right? From a longer term perspective. My hesitation on a lot of the narratives here is that, as is often the case, it takes longer than people realize, and it tends to be much more costly to sort of go to the extreme of what Bitcoin can be for the system. And in the meantime, there's going to be all kinds of bumps in the road. So let's talk about, from that perspective, CBDCs a little bit more. Where are we on CBDCs? A lot of people have been talking about it's only a matter of time till the Fed put something out there. We know they're working on something. I get the sense that the Fed may not actually go that direction for other reasons. But give us an update on sort of what you've seen from the central banks globally as far as it relates to CBDCs.
Yeah, so in my book, I dedicated a whole section to how you would use, the governments will have to use a digital currency in order to remove fractional reserve banking at its extreme, and how you do that without wiping out shareholder value. And so what happened in the 2023 side was an iteration of what I had covered in Bank to the Future in Protect Your Future for Gums Go Bust in 2011. And I started talking about central bank digital currencies in 2016 as what I believe to be inevitable, predictable, and guaranteed. And so I believe that the only tool, maybe there's another round of 2 or 3 tools, but we've already seen during this cycle that whenever the Fed commits to the trying to combat the excessive money printing, you tend to get something that has to be pivoted eventually because of the side effects. And so I believe I subscribe to some of Ray Dalio's kind of cycle theory that many people would probably be familiar with. But I believe that a central bank digital currency is actually one of the most disruptive and inevitable, predictable, and guaranteed forms of banking reform we will experience, because essentially you could use a central bank digital currency. And I was saying they need to get their CBDCs ready for when banks fail and when you have the bank runs. Because the easiest way, rather than backstopping the whole system and re-leveraging, and getting taxpayers to pay and the hidden taxes and everything they're doing right now, you could just openly say we are moving to a system where we let banks go bust. And rather than putting more leverage in the system in order to save the over-leveraged banks, we could use the central bank digital currency that's not backed by debt, that is actually just replacing debt-based money with debt-free money issued by a central bank. And people think, well, won't that be a massive increase in the money supply and inflationary? No, it's deflationary, because you're just replacing one form of money with another. So imagine that you're at a bank, you're at Chase, and Chase is needing emergency measures. You could just let the bank go bust and require everyone to download a digital wallet where they would find a CBDC balance equivalent to the amount that they had in their account. You could auction off all the debt, as you do with any FDIC takeover, But you've taken out all of the debt that's backing the money at the bank, and obviously replaced it with debt-free money that's issued by a central bank called a central bank digital currency. And I just think that that's inevitably how you stop banks going, bust in the future without depositors losing their money. And so, if you look at it, 90% of every central banks are now launching or developing or researching their central bank digital currencies. In 2025, the Bank for International Settlements has released how you can hold cryptocurrency, and how you can use stablecoins and central bank digital currencies at the central banking level. You've got the projects. China started working on its central bank digital currency in 2014, picked up the project again in 2018 when Libra left out the Chinese yuan from the basket of currencies that they were going to use to back their digital currency that they tried to do at the corporate level. And they've already got it integrated with all the banks. They've got it integrated. The whole of China has already disrupted cash with WeChat Pay and Alipay. It's integrated at that level. They've already got a line on their balance sheet that explains how much central bank digital currency makes up the total money supply. It's still under 1% of the money supply during the rollout phase. But they're also issuing Belt and Road Initiative loans, exploring using if you want to get a loan in Chinese yuan, then you have to also adopt our central bank digital currency. So it's going at a really, really fast rate. And to me, it's the only final tool. It comes at a massive cost. Don't get me wrong. The cost is freedom, privacy, liberty, but I think we ended that when we decided to roll over these Ponzi schemes through every financial crisis, and when America gave up on free markets and the rest of the world followed.
Just to reset the room for the remaining 15, 20 minutes, so everybody please make sure you follow Simon Dixon here on Twitter. If you want to come up and ask questions, click that bottom left mic request button. And as always, I will have this as an edited podcast. By the way, I know, Simon, you do a number of very large Twitter spaces. I tend to run these more, as you can tell, like a one-on-one podcast. But if anybody wants to come up, feel free to engage. Okay, I want to get your take on where we are in the other cycle. We talked about the 4-year cycle, the leverage cycle, maybe all that's tied to the crypto bankruptcy cycle. Do you think that SBF, with hindsight, maybe marked the end of the blowups, or do you get a sense that there's still more damage that's coming?
Yeah, it's so. Firstly, it's a political question. It's a regulatory question, and it's also just so there's several more where we don't know the outcome yet. One of those is Binance. One of those is Tether and Bitfinex. And full disclosure, I'm a shareholder in Bitfinex. I'm a shareholder in Circle. I'm a shareholder in Coinbase. I'm a shareholder in over 100 different companies across the industry. I try not to let that change the way I share things. But I just try and disclose that just so people know when I'm saying things. So there's, Tether is essentially created this incredible business model, which has both risks and, and threats to what the US want. And so that creates a very, very challenging environment. Tether has approximately, during the bank run crisis, its volume when, the US regulated version of the stablecoin USDC, when that suffered because it was using a US bank and it had about $3 billion in, I think it was Silicon Valley Bank, or it was, I can't remember whether it was Signature or Silicon Valley, actually. It's all moved so fast. That drove a lot of volume over to Tether. So it went up from approximately 60 billion to about 85 billion now back in that stable coin, which is where you give your dollars to Tether and they don't pay you any interest because they provide a stable coin that has massive utility, because you can send dollars around the internet person to person, as if it were Bitcoin, which is something very useful if you're either an arbitrage trader or you live in a country that's suffering hyperinflation and you want to get access to dollars, but you can't get a dollar bank account. It's got several very, very useful things. But they get 0% interest money, and then they got to buy all of the higher rate treasuries. And so they were pulling in billions of dollars of profits, and the excess profits they were using in order to buy Bitcoin. And so they ended up in this cycle with like 50,000 Bitcoin that essentially the US government was subsidizing through treasuries, and creating dollars that exist outside the US banking system that were incredibly useful, to those that couldn't access dollars. Um, so that's a very threatening model. It's confrontational. And so you've also got that, the outcome of that. Regulators, I mean, obviously, it's been a target with DOJ for a long time. That's not going to be happy, but they also haven't managed to take it down yet. On top of that, there's also Digital Currency Group, which they were involved in some of the massive leverage between FTX, Three Arrows Capital, the multi-billion-dollar holes. They were on the receiving side through some of their subsidiaries, which then connected to the Winklevoss twins through Genesis and Gemini. These are still unresolved, and FTX is going after Binance for like 2.1 billion. They're going after Digital Currency Group for about 4 billion. Celsius and FTX, they were deeply intertwined because Alex Majinsky created a pump and dump scheme in order to fill a hole and hide the multi-billion-dollar losses he made and extract massive value and theft and fraud from creditors. He pumped the price of a token that he all did through FTX. And there's a subpoena to get all that data right now of what was happening during the massive fraud and manipulation. And so you still got a bunch of shit to figure itself out, probably for the rest of this year. I mean, the FTX one's going to go on for quite some time. But I think those are like the three unknowns. Those we need to figure out their outcome. But from my perspective, again, if you're playing the game, a simple philosophy, which is my philosophy, I believe that there will be a demand for more people to own their own money in a way where they can do it without a counterparty. I believe that there will be a demand for people to transact peer-to-peer with less censorship, but a compromise where there's an immutable record on a blockchain in case you're committing crime with that law enforcement can follow into the future. And I believe that people will want a money supply that they can rely upon that never changes and is fixed and creates digital hard sound money. If you believe in that, then I also believe that if you own more Bitcoin every single month than the previous month, then you are accumulating digital hard sound money that I believe will be very infinitely more useful and people will pay a lot more dollars for into the future. And so that's, play the 4-year cycle. If you want to play the whims of every up and down, every ebb and flow, this industry is wild. There's a lot of leverage in it because the hedge funds have a lot of volatility to play with. But I want the price to be as low as possible for as long as possible, because I believe that the demand for that goes up over time, and obviously there's an element of risk there because we've only been at this for 14 years, whereas gold's been at this for 5,000 years, which is why the returns have been asymmetric relative to other stores of value that preserve your wealth like gold.
Go to Greg Foss for a question. Go ahead, Greg.
Hey guys, thanks for having me, Michael and Simon. Very, very interesting chat. I'm actually reconsidering whether I should ask this question. You can tell me, we can take it offline. I wanted to dive deeper on your CBDC commentary and how replacing existing essentially digital fiat with a new coin, if I understand it correctly, would function. What happens to all the assets, the loans that are funded by the bank that is let fail?
Yeah, so rather than a coin, it would just be another digital dollar.
Fungible though,
And
Simon? Fungible one for let's say, a US dollar, or?
yeah, so if you look at the balance sheet of a bank, they will have their assets and liabilities. Everyone that had 10,000, if you had $10,000, you would receive $10,000 of a CBDC.
The
And
depositors, I'm assuming you're talking about.
sure,
Yeah,
the
the
depositors,
liability.
yeah.
Okay.
And I'm pretty sure that the Fed will either auction or put it all on their balance
There you
sheet.
go. You
And
see, so the fiat Ponzi still exists because the Fed will have to take the assets of the failed bank. Like, that's the one side of the equation. You can replace the depositors and make them whole and essentially not have a bail-in, but the assets of the failed bank have to go somewhere. Anyway, you know what's cool? I loved your talk. It is a fiat Ponzi. The banks are the fiat Ponzi transfer mechanism. And even with a CBDC, it still gets booted up to the highest level. So the fiat Ponzi continues. Anyway, great talk, you guys. Hats off to both of you. Learned a ton. Rock and roll. Go Bitcoin.
thank you. Yeah, I mean, it still leads to, you have to increase individual debt, you have to increase consumer debt, you have to increase
and
business
therein
debt,
is the
you have to
reason that the
increase.
fiat Ponzi will exist with 100% certainty, because the only way that the fiat Ponzi continues is QE infinity. It's the only way to pay the interest expense burden on the outstanding debt. I've never seen a more simple trade in my entire life, and people are trying to overthink this. Understand how banking works, and you'll realize how Bitcoin is the solution. Amen to you guys.
So that actually brings up another dynamic. There is a lot of passion in the Bitcoin community, and I think that's a positive. I also think that in some ways it can be damaging, just from a perception perspective, right? Because and I'm sure, Simon, you've seen this, Greg, I'm sure you've seen this too. Passion brings out a lot of positive emotions, but also a lot of negative emotions that ends up getting into sort of argumentative types of yelling and screaming. I'm right, you're wrong, whatever it be. And I get the sense that there needs to maybe be a bit of a transition away from emotional takes on Bitcoin to kind of more rational back and forth conversations, which I know happen, right? But it's the loudest that tend to get the most attention, arguably. I'm curious. Yeah,
can I jump in? Sorry, Simon. That could be directed at me. Certainly, when I had my rage against the machine after the Bitcoin conference, and I have apologized about my delivery, but not my message. My message stands. But let's put that aside. I've been at this since 1988, when I graduated in the USA and came back to Canada and worked for Canada's largest financial institution, Royal Bank of Canada, right when the Latin American debt crisis was in full swing. And I worked directly for the CFO, and I was quickly able to figure out that the Royal Bank of Canada was insolvent. And I went to the CFO and I said, Emil, we have a problem. And he said, I know, don't tell anybody. But now this is 1988, and Royal Bank of Canada wasn't alone. In fact, it was the U.S. Treasury Secretary Nicholas Brady that solved the LDC crisis for the likes of Chase Manhattan, Manufacturers Hanover. Notice none of these banks exist anymore. They've all been combined. Bankers Trust, because they all had the same problem. They were insolvent based on the leverage in the system and having loaned petrodollars essentially to developing nations. And they started with the Mexican Brady bond solution, which was accounting gimmickry to get the banking system back on track. They turned a 5-year loan into a 30-year obligation backed by U.S. Treasury zero coupon bonds. So this has been going on for 30 plus years. And you guys say that it was the financial crisis that started it. No, it was the financial crisis that was the big blow. But this has been going on since banking has existed, because banking is banking. It's 25 times levered to its equity capital base. And that's the problem. So passion aside, I appreciate the time to, rage a little bit. But this is because I've been at
Yeah.
this for 30 years and nobody seems to be
No,
listening.
I get it, and Greg, to be clear, I wasn't directing it to you. It's more just sort of a commentary on sort of what that term toxic maxiness, if that's a word or phrase, right? So
I
that's kind
own
of where I'm
only
going at.
Bitcoin as my digital assets, but I only own 40% of my net worth in Bitcoin. I am not a toxic maximalist as defined by some other people. But
Right. No,
Simon and I
again,
agree on so
I'm not.
many cool things.
Yeah.
I'm so happy I tuned in to listen because I found a guy from another country who's been at it and sees all the same things I've seen. And I'm not saying I'm right, by the way. I'm just saying I'm passionate about what I've lived through. So I'll step down, guys. You are once again putting great education on the platform of Twitter Spaces. Don't take for granted that the fiat Ponzi will evaporate, because it can't. It's called commercial banking, and that is the transfer mechanism of the fiat Ponzi. Thanks again, guys. I'm stepping down.
Yeah, no, okay, Greg. But so Simon,
Thank
I
you.
want to get your take on that point, because I do think
Yeah.
this is the way. So look, I was attacked by the Maxi mob in like February 2021 when everybody was putting laser eyes, right? And I was trying to have discussions with people, but it was very kind of argumentative and insulting. And I think that's more just sort of greed and overconfidence. So maybe it's not fair to just isolate it to that, because you can say that around Tesla, Maxis, and I've used that line before: when an investment becomes religion, it's time to lose faith. But where I'm really going with that is, do you get a sense, Simon, that the emotional aspect of the communication, to Greg's point, the way that it's delivered, that's going to abate? Because I think that's the only way you can really bring in more people to believe in Bitcoin, as opposed to I'm right, you're wrong, the whole system is fucked, so you got to buy Bitcoin.
Yeah. It's a really interesting topic, and you know, again, my most favorite time in Bitcoin was when there was only Bitcoin and it was just us versus the banks, and we were like the annoying little fringe project on the side that was never meant to succeed. Everyone was laughing at us, much like some new bloody meme coin or something that comes along. But that was my favorite time, and there is no doubt in my mind that Bitcoin is a religion, and the similarities between how people feel about Bitcoin and how people feel about religion are there. There's no doubt about it. Bitcoin means so much to me because it just did so much for me in my life. So I can't help but see things from the world of a Bitcoiner. But at the same time, I very deliberately concentrate on questioning my narratives, very deliberately, and try on emphasize the arguments of other people, and understand that being wrong is a part of being a good investor as well. So everyone picks the type of person that they like to listen to. There's more over aggressive, there's more toxic maximalist, there's more comical, there's more down to earth. People just pick who's right. But I'll tell you how I deal with it. So firstly, I split the world up into three. And I believe that there is an existing empire, there's a change of empire, and there's a system outside the current financial system. And so the way that I've managed to achieve balance in my life is, for 2 decades now, have believed that the entire US retail, real estate market is due to crash, due to implode, kind of like a bit of a Peter Schiff type narrative. And you can go broke betting against the Federal Reserve, trying to wait for what is probably right to happen. And I've experienced that over the last 2 decades. And so I believe that the future of the US banking system and the current empire will roll over into a CBDC, and they'll give up on capitalism, freedoms, liberties, and take away people's privacies, freedoms, and transition to, when I look at the world, I think China looks more like America every day, and America looks more like China every day. That's the world that I see from a non-Chinese, non-American that spent a lot of time living in Hong Kong, and spending a lot of time visiting America and visiting China and speaking, and having many friends in those different areas and business partners in both jurisdictions. And so that's, I see a world of don't bet against the Federal Reserve. So I have my traditional US dollar portfolio, and it's kind of a very conservative thing. It rarely beats inflation, but that's my portfolio. It's your traditional stock and bonds, use low cost index funds, and just 101, investing, as it were. I also have a portfolio for, I believe in my lifetime there will be a change of empire, and I believe during that change of empire, if it leads to wartime, where no one trusts each other's fiat currencies, then traditionally people have cleared in gold, and gold becomes the only thing that people can trust when settling with each other. So I have gold, and that's based upon one day this whole freaking internet thing, everything could go down, the satellite, the doomsday scenario. But I still want to be okay in that scenario, and so you got to get the right balance between self-custody and physical custody, and not using paper and leverage, because the gold doesn't exist that's backing up all those paper claims. But the one portfolio that has changed my life radically, and has given me more freedom and prosperity and allowed me to do everything that I want in my life is the Bitcoin side. And I'm not I believe that Bitcoin has a monopoly on digital hard sound money. I don't think that the set of circumstances that made Bitcoin a commodity will happen again. But I do also believe that there is some other types of innovation that comes from this sector as a whole. So I put 5% of my Bitcoin in the Ethereum ICO, and I've still got those tokens. And I'm more than willing to mess around with a percentage of my Bitcoin in order to try and generate more Bitcoin, because I have a simple model that I need more Bitcoin every month than I had the previous month, and that's just the foundation of my Bitcoin approach and strategy. You can either buy it or you can invest it, but also that's blown up a lot of wealth for me. I had almost approximately, if you take it across the different coins, about 1,000 Bitcoin in Celsius. That's a very embarrassing thing, because I was experimenting with not selling the Bitcoin, and that cost me a lot. But overall, I was also a shareholder in about 10 unicorns of 100 companies that went from, $10 million valuations to multi-billion-dollar valuations. And so it kind of balances out. And I don't know how people just tend to stick to one narrative. And I just don't I reached an age when I was younger, I was more than happy to do that. But you reach an age when, risk management matters. And the worst thing, the reason I saw a lot of people, so I know people that were at that first Bitcoin conference that are still in the same financial position, despite being involved in the highest performing asset class in history. And that is because they overtraded, they didn't do risk management, or they had to sell their Bitcoin in order to meet their living expenses. And so these are real things that you have to manage. And balance is the only way to do that. But I really take your point. It's a crazy world out there, but isn't that just the world in general?
That's a good place to wrap this Twitter space up. Again, everybody, please make sure you follow Simon Dixon. Check out his Twitter spaces as well. This will be an edited podcast. Simon, for those that are not on Twitter listening to this as a podcast, how do people find you?
Sure. Yeah. Thanks for that. So just on Twitter is best by spend far too much time there. I've got a YouTube channel, Simon Dixon. And for those that want to invest in this industry, we run banktothefuture.com, which is mainly for high net worth investors that want to build more Bitcoin every month, basically.
Thank you, everybody. I'm doing another Twitter space literally now with Jason Shapiro talking about small caps, large caps, melt-ups, crashes, treasury. So, yeah, nothing major. I'll see you all very shortly. Thank you, Simon. Appreciate it.
Awesome. Thanks for having me.
Cheers, everybody.